Hi everyone, it's Jab out another video, and today I'm going to be talking about Disney, a stock that everyone knows, one of the most famous companies and most recognisable brands in the world, but it's definitely a business and a stock that has fell on hard times recently. Just 18 months ago, we saw numbers close to $200, right now it's at $81, right at its 52-week low really of $80.50, and way off its 52-week high, $118. It's been a really bad stock to own the last couple of years, and that is in direct contrast to what it has been over the long term. It's been an excellent long-term performer, which is why it has got such a strong reputation and is seen as one of those forever stocks. But the business has definitely fallen harder times, and I want to establish whether this is a potential value play right now. Obviously, the valuation has came down a lot from what it has previously been, so we'll analyse whether this is a value stock right now or whether there's a lot more work to be done around this business. Here's a table of some valuation metrics for Disney over the last 5 years compared to its current ones, and then a 5-year average. Right now, its current trailing price earnings is 66. This is obviously because earnings are depressed. It has a price to forward earnings of around 15. I'm not sure how much stock to put into that based on analyst expectations, because Disney has been struggling a little bit. So we'll see how that plays out, because they have been disappointing with a lot of their earnings recently, as we'll talk about in a minute. But nevertheless, this is what analysts are expecting right now, and that is below 5-year averages. The 5-year averages are obviously massively inflated by 2020. This is more in line with 5-year averages really. Definitely cheaper than it was last year, but right around normal for this business without that 2020 inflated number. In terms of price earnings, again, this is right in line with where it has been for the last few years, but when times were a bit more normal, 2017, 2018, 2019, it is far above where we would like it to be on a trailing basis, and cash flow is not a particularly impressive number. 20 times cash flow in 2017 and 2018 is around 14 and 11.5 times cash flow. So I don't think this business is exceptional value by any means right now. Of course, the earnings numbers are depressed for Disney as of recent times, so we'll see by looking at the results. Do we expect them to increase going forward? So let's get into the most recent results we have. That's the Q3 results for 2023. Revenue up slightly, less than 10%, $21.5 billion the year prior, $22.3 billion this year. Very impressive scale for one thing. $22.3 billion in a quarter is absolutely outstanding revenue wise, but they're just not converting this to sustainable profits. Total segment operating income of $3.6 billion, that was flat for the year. They swung to a loss, over $2 billion swing to a $100 million loss. Diluted earnings per share from continuing operations, a loss of 25 cents. This is what's actually attributable to shareholders, so I'm not interested in the exclusion of certain items. And even if it was, that has decreased year over year. So this is absolutely going in the right directions. The margins here are absolutely putrid on a net basis. Going into the segments in a bit more detail, I'll start with the one that gets all the headlines. That's of course Disney Plus. Now I think this transition towards Disney Plus and transition towards streaming has been really tough for Disney, and I think it is tough. It's basically seen off one manager, and it's because they're cannibalising their own theatrical releases, their own cinematic releases numbers, and the domestic subscriber growth is just not really there anymore. Domestic subscribers actually decreased by 0.3 million. These were effectively all the average revenue per user comes in, far higher average revenue per user than international. And Disney Plus International grew by just 1.1 million from 58.6 to 59.7 quarter over quarter. These are of course quarter over quarter numbers. They gained around 10 million year over year. But when you look at the domestic subscribers, that's pretty much flat. Doesn't look like it's going anywhere year over year. It's probably going to go down, given that many of these streaming services people see as interchangeable to theatrical releases, and things go into Disney Plus do not look that strong going forward. I think there's going to be a really tough business model to swing. It's also absolutely chewing through cash. So this, to me, is a real drag on Disney Plus, whereas a few months ago, I would have said that Disney Plus is clearly the growth driver for this business. I thought this article from Hollywood Reporter really neatly summarised what's some of the bear cases against Disney. First of all, the management, which it doesn't specifically mention here, but getting rid of Bob Chapek, bringing back Bob Iger, who is, from a media point of view, is absolutely down in the dumps right now PR wise because of all the talk about the strikes and things like that, and is also doing a pretty poor job. I think there's going to be a lot of downside to direct to consumer. It's not exactly a hit factory recently. The box office is suffering. Disney subscribers, if they continue to not be a hit factory, will suffer, especially with price increases. This is going to make the direct to consumer eat cash already more than it already does, and they do spend a lot on content, perhaps not as much as you'd think, but around $10 billion. There's growing concerns that ESPN will not transition particularly well to streaming, and that is kind of the case, as we've seen. They generally believe that it won't be able to successfully divest its non-core linear. Now, I'm an eternal optimist. While I do see these concerns, I still think Disney has an incredible IP library. It's an incredible appeal to kids and families, meaning at the current price point, which is $10, I think you can definitely make the argument for it in most households. Massively underpriced versus Netflix on $1 per month. I don't think Netflix is actually that good anymore. I think Disney Plus has a great offering per dollar. They just need to bump the average revenue per user up and keep the domestic subscribers going in the right direction rather than the wrong direction. Of course, that's just one side of this business. The strongest side of this business, or the strongest section of this business, whereas if it was spun off I would buy it pretty much immediately, is the park segment. And while results this year weren't that great, operating income decreased 13% versus the year prior, so low results at domestic parks and Vacation Club, which is offset slightly by the Disney Cruise Line. I still think this is an absolutely fantastic business, incredible margins for what it is, and generally is an absolutely international powerhouse, which would be a much better business on its own. And it's pretty much the only reason why Disney isn't absolutely bleeding cash at the minute, because it's producing consistent operating income. This is just the media and entertainment distribution business as a whole. Linear networks suffered greatly. Operating income declined significantly by around $580 million. There's obviously been a significant amount of cord cutting here. The direct-to-consumer business performed better on the revenue side of things, but in terms of operating income was a massive loss leader. While it is significantly less loss than the year before, it's still not really good enough. Disney Plus, Hulu and ESPN all improved their operating income or reduce the loss, but still not really what we want to see. So really the bull case with Disney depends on how much you believe the studios can leverage their incredible IP library, continue to bring out high quality titles, perhaps increase the cost efficiency of these titles, and embrace multiple distribution avenues. The parks and experience continues to be an absolute powerhouse. They have a diverse portfolio of experiences span across the globe. They have greater efficiency, maximise the margins, and are sensible with their investments. And of course, I would love to buy the parks and experience business on its own, and I definitely think there's just a bull case for the parks and experience business to continue to exhibit strong growth. It's streaming and the studios segment of the business I'm really having trouble with. I think they're going to struggle to have sustained profitability with the streaming business in the next 3 or 4 years, certainly. Volume of the content, what they spend, markets they invest in, a lot of balancing out there, a lot of competition in this space. I think this can be very difficult, and that's really what investing in this business comes down to for me, is whether I buy into the fact that they can make streaming a sustainably profitable business in the medium term. I'm not sure they can. I think it's a final aside to be a reflection of the results going forward. Look at the next year or so of releases for Disney Plus, or effectively the upcoming theatrical releases. This is absolutely putrid compared to what it would have been 3 or 4 years ago. None of these are particularly jumping out at me. I guess Kingdom of the Planet of the Apes, the Marvels, some of these are interesting, definitely. But overall, this is an absolutely putrid slate and just not going to generate the theatrical buzz that Disney, where Marvel's heyday of 3-4 years ago would have generated. Overall, I think this has the potential to go back to being a fantastic business, but plain and simple, it's just not cheap enough right now given the business's performance. Yes, sentiment is down significantly on this business, so the price is depressed versus what it used to be, but its sentiment isn't down enough for where this business's results are coming in. Earnings are depressed, perhaps in the short to medium term, and then you could possibly rationalise buying at this price, given that you'll think it'll be higher in 10 years, which I almost certainly think it will. However, the business is so embattled, it has such a poor balance sheet after that 20th Century Fox acquisition that I can't really rationalise buying it at today's price. I just don't think there's enough margin of safety. I think the sentiment is so against this business. I could see it, definitely going down from here, perhaps even as low as $50. So if it gets that price, I think I'll be buying at $50 if it gets there. I'm not sure it will, but I definitely think there's a possibility. But anywhere in that 60-70 range will be very, very interesting in this business. But of course, that's just my opinion. You should let me know your opinion in the comments down below. I'm not a financial advisor, so you shouldn't consider this financial advice. Do your own research and due diligence. Capital is always a risk when investing, of course. I'll see you again next time.